Welcome back to Sensible Dollars and Cents. A new year is upon us and you've thought about a New Year's resolution. You have made them in the past but had trouble keeping up with it. This time, you know what you want and your goal is to start saving and investing. In this episode we will discuss 15 common financial terms that will help you get started in saving and investing towards becoming financially fit. So, you're now ready to start saving and investing, however, you're not sure what these financial terms mean. In personal finance there are hundreds of terms that are not easy to understand. It's as if we're speaking a foreign language and would require an interpreter. Well, don't worry, we're here to help. We know personal finance isn't taught with a manual or come with a technical support hotline, so we will tackle this need-to-know terms together. If you would like to see more types of content like this, please like, subscribe, share and provide comments down below. 1. Diversification. In finance, it's a technique or strategy that selects various types of investments within a portfolio to reduce the exposure to any one risk. An example to this is if you were only invested in the real estate market during the housing crash, you would have been hit hard. But if your portfolio included a mix of different investments such as stocks, bonds, cash, and real estate, it's possible you would have fared better. Here's another simple explanation. Let's say you own a fruit stand which represents your portfolio and you only sell Fuji apples. You may diversify or spread the risk by adding red delicious or Honeycrisp apples or by expanding into oranges, strawberries and other fruits. Here are the benefits of diversification. It reduces the risk of loss in your overall portfolio. In other words, diversification would reduce the potential loss in case people get tired of buying apples, since you would have other kinds of fruits to sell. Diversification helps protect you against market cycles, which means having different fruits help you stay in business, since you will have the variety of fruits to sell even if apples are out of season. Diversifying provides a window for more opportunities or better return. The other fruits you sell may become more attractive to buyers, therefore becoming more in demand and in turn, sell more for profit. Diversification also reduces volatility. Simply put, this allows customers to buy fruits at a steady price, helping you avoid changing prices often and potentially lose customers. Let's further examine what volatility is. 2. Volatility. To continue along the example above, volatility is the degree or speed in which the fruit prices go up and down. The wilder the prices go up and down, the bigger the opportunity to make money. However, the wilder the prices go up and down, the greater potential to lose money as well, since customers would rather go somewhere else where the price remains steady, if not lower. Remember this statement: the higher the volatility, the higher the risk. 3. Asset allocation. If diversification is the strategy in reducing the exposure to any one risk, asset allocation is the process in getting you diversified. Just like my example above regarding the fruit stand, you divide, or allocate, your portfolio among different types of fruits. In this case, adding oranges, strawberries, bananas, kiwis, or blueberries will help keep your fruit stand diversified. In investment terms, you allocate your portfolio among different asset classes, like stocks, bonds, cash, and real estate, which are often the most common types of investments to help with diversification. 4. Bonds. A bond is a debt instrument often issued by corporations or governments to raise money. These corporations or government entities are referred to as the issuer. When you buy a bond, you become a bondholder. You are lending money to the corporations or governments in exchange for a fixed interest rate payment as part of the money being returned back to you for loaning the money. 5. Stocks. In investment terms, stocks are a type of security that represents ownership in a company. When people buy stocks of a company, they become an investor to that company. There are two main kinds of stocks, common and preferred. I'll provide more details in a moment. There are several reasons why investors buy stocks, and here are the top 3. Capital appreciation. If you're an investor, you want your money to grow. This happens when the money invested in the company's stocks appreciate in price. Another reason is to get paid with dividends. Dividends are payments to investors after a company earns a profit. It can be considered as a reward for investing in the company. It can be paid back in shares of the company or in cash. Also, to influence the company. When you buy stocks, it is possible to have an influence in the way a company is run. If you invest a considerable amount of money in a company stock, the shares you purchase represents the number of votes you can cast during the shareholders' meeting to elect officers of the board or to vote for company mergers. There are two kinds of stocks. They are referred to as common stock and preferred stock. Let's dive deeper. 6. Common stock. This term is generally used to describe shares of a company in which entitles the owner voting rights equal to the number of shares they own and in which stockholders receive dividends. 7. Preferred stock. Also called preferreds, is a form of stock which combines features of ownership as well as a debt instrument. This is often considered a hybrid security. Preferred stocks are ranked higher than common stock when a company is forced to pay back investors during bankruptcies or in the event of liquidation. 8. Mutual fund is a type of investment that holds a basket of different stocks or bonds or other securities in a portfolio professionally managed with money collected from many investors. Mutual funds are often a cost-effective way for the average small investors to invest, since the entry level could be as low as $100. 9. Compound interest. In simple terms, this is money that is earned on the amount you invested or saved plus any interest you've earned over time. This term is also used when borrowing. The interest is the amount charged on the original loan amount plus the interest charges that are added to your remaining balance over time. Consider it this way: it's the interest on the interest on the interest. This will help your savings or debt grow at a faster rate. 10. Simple interest. Unlike compound interest, which includes the accumulated interest over a period of time, simple interest is only based on the principal amount of the loan. In other words, the interest paid or received over a certain time frame is a fixed percentage of the principal amount that was borrowed or lent. I'll include a link in the description of an example how the simple interest or compound interest is calculated and the differences between the two. Source: Investopedia. 11. APR stands for annual percentage rate. More than likely you've seen this when you are looking to borrow for a student, auto or a home loan. This is often confused with interest rate. They are not the same, but are related. Consider interest as the cost of taking a loan. Interest and APR are displayed as a percentage of the loan amount, but APR includes interests, fees and other costs. By default, APR is always higher. Here's a fact: the law requires lenders to abide by the Truth in Lending Act, which requires them to tell you the APR when offering a loan. Compare APRs, not interest rates, when you're ready to shop for a loan. 12. APY. This is another term often confused. APY stands for annual percentage yield. It is the amount you pay to borrow or the amount you earn on savings annually, including compounded interest. APR does not include compounded interest, APY does. Consider comparing APYs when you are looking to put money in savings accounts or investment products, borrowing a loan or using credit cards. 13. Net worth. You may hear this term being thrown around when discussing wealthy individuals. However, this applies to everyone, the only difference is in the number of zeros behind their wealth. In short, your net worth is calculated by adding up all that you own, referred to as assets, which includes your money in the bank, investments, home, car, retirement accounts or other items of value, minus your liabilities, which is another term for all that you owe or your debt. This includes your mortgage, credit card balances, loans or any obligations. The result is your net worth. 14. Amortization. The simplest explanation to this is if you purchase a home with a 30-year period to pay, amortization would refer to the process of paying off your loan over that period of time in regular monthly installments. Your mortgage is amortized using the monthly payments calculated from the amount borrowed, plus the interest on the life of the loan. 15. AGI. This term is often used during tax filing and it is short for adjusted gross income. Your AGI is calculated by taking your gross income, income earned from your job, interests on investments or a pension, minus deductions. The AGI is often used to help determine your taxable income as well as whether you qualify for certain credits or deductions. Visit www.irs.gov for further information. Since we've been discussing topics to help you become more familiar with finance terminologies, it's important to note that all investments carry some level of risk, including the potential loss of money. There's no guarantee on any investment strategy to protect against loss or to make money. Stocks historically have outperformed bonds, but they also have historically been more volatile. You should carefully consider your ability to invest during volatile periods and seek guidance from a financial professional. How do you feel about the list provided? What would you do with this information? What other financial terms would you like us to cover? Please include in your comments down below. If you learned something new today, please hit that like, subscribe and share button so you can be alerted the next time we post new content. Thank you and good luck.